Begin with a quiet but unsettling observation. If building wealth were simply about finding the next great stock or predicting the next booming industry, millions of intelligent, hardworking investors would already be financially independent. Yet history tells a different story. The greatest fortunes are rarely built by those who constantly chase the next opportunity. More often, they belong to people who consistently make better decisions long before those opportunities appear. Introduce Warren Buffett as an example, not because he possesses secret market knowledge or an ability to predict the future, but because for decades he has demonstrated something much rarer, the discipline to remain rational when others become emotional. While markets swing between optimism and panic, Buffett's greatest advantage has often been the quality of his judgment, not the speed of his actions. Present the central question that will guide the entire video. What if becoming richer than most people has less to do with what you buy and far more to do with the decisions you repeat every year? Suggest that this idea challenges one of the biggest misconceptions about wealth. Most people spend years searching for better investments, yet spend very little time improving the thinking that shapes every financial choice they make. The market may change, technology may evolve, and entire industries may rise and fall, but disciplined decision-making has remained valuable through every generation. Hint that Buffett's extraordinary success can be traced back to 7 surprisingly ordinary decisions, choices that do not require genius, perfect timing, privileged information, or enormous wealth to apply. They are available to almost anyone, yet they are quietly ignored because they appear too simple to matter. Invite viewers to explore these decisions with an open mind, because by the end of the video, they may discover that the most important investment they will ever make is not in a company, but in the quality of the decisions they make every single year. At first glance, today's investors appear to have every possible advantage. Financial news is available every minute of the day, thousands of books explain investing strategies, and with a smartphone, anyone can buy shares in companies across the world within seconds. Information has become cheaper, faster, and more accessible than ever before. Yet despite this unprecedented access, long-term financial success remains surprisingly uncommon. The reason is both simple and uncomfortable. Information alone has never created wealth. Decisions do. Many people quietly fall into the habit of believing that the next article, the next market prediction, or the next investment trend will finally provide the breakthrough they have been searching for. Instead of building a durable decision-making process, they become trapped in a constant cycle of reacting. Every headline feels urgent. Every market movement appears meaningful. Every new opportunity seems impossible to ignore. Over time, this creates a dangerous illusion of progress. Investors mistake activity for achievement. They buy because prices are rising, sell because fear spreads through the market, and constantly adjust their plans in response to short-term events. They remain busy, but their financial future changes very little because their decisions are driven more by emotion than by principle. Another hidden obstacle is lifestyle inflation. As income grows, spending often grows just as quickly. Financial success becomes measured by visible consumption rather than growing ownership of productive assets. Many people earn more than they did a decade ago, yet save and invest little more than before because each increase in income is matched by an increase in expenses. Comparison quietly makes the problem worse. Instead of evaluating whether a financial decision strengthens their long-term future, people compare themselves with friends, coworkers, or strangers on social media. Wealth becomes something to display rather than something to build patiently. Warren Buffett has spent decades demonstrating a very different philosophy. Rather than trying to make countless brilliant decisions, he has focused on avoiding unnecessary mistakes. He understands that every poor financial decision compounds just as every wise one does. A single emotional choice may seem insignificant today, but repeated year after year, it quietly shapes an entirely different financial future. Before changing investments, Buffett's approach suggests changing something much more important: the quality of the decisions that guide them. That is where lasting wealth truly begins. To understand why decisions matter more than predictions, it helps to look at one of the defining moments in Warren Buffett's career. In the early 1960s, the American financial world was shaken by what became known as the salad oil scandal. A major commodities fraud caused widespread panic, and one of the companies caught in the turmoil was American Express. Investors feared the company's reputation had been permanently damaged. Its stock price fell sharply as thousands rushed to sell before things became even worse. For most people, the decision seemed obvious: stay away. Fear dominated the headlines, uncertainty filled the market, and selling felt like the safest option. Yet Buffett approached the situation differently. Instead of reacting to the panic, he asked a much simpler question. Had the long-term value of the business truly changed, or was the market simply reacting emotionally? Rather than relying on rumors or market sentiment, Buffett went out into the real world. He visited restaurants, stores, and businesses to observe whether people had stopped using American Express products. What he discovered was striking. Customers continued to trust the brand. Merchants continued to accept its services. Daily business carried on much as before. The scandal had damaged confidence in the stock price, but not necessarily the underlying strength of the business. That distinction changed everything. While many investors were trying to escape uncertainty, Buffett saw an opportunity created by emotion rather than economics. He invested heavily in American Express, confident that the company's long-term value remained intact despite the temporary crisis. Over the following years, that decision became one of the most successful investments of his early career, producing extraordinary returns and reinforcing a lesson that would shape his philosophy for decades. The real story is not that Buffett bought a particular stock. Thousands of investors could have purchased the same shares. The difference was the decision that came before the investment. He chose independent thinking over crowd psychology, careful observation over sensational headlines, and patient analysis over emotional reaction. That pattern has appeared repeatedly throughout Buffett's career. Whether markets were booming with optimism or collapsing in fear, his greatest advantage was rarely superior intelligence or secret information. It was the ability to remain calm when others allowed emotion to make their decisions. His success reminds us that extraordinary wealth often begins with an ordinary moment, the choice to think clearly when everyone else is reacting impulsively. When people study Warren Buffett, they often focus on the companies he bought. But the more valuable lesson lies beneath those investments. Every successful investment he has made was preceded by a series of thoughtful decisions. Those decisions became habits, and over time, those habits compounded into one of the greatest investing records in history. The first decision is to think like an owner rather than a trader. Buffett has never viewed stocks as numbers moving across a screen. Instead, he sees them as ownership in real businesses. This simple shift changes every investment decision. Owners care about long-term value, while traders often become distracted by short-term price movements. The second decision is to protect your downside before chasing your upside. Buffett's famous rule, never lose money, is not about avoiding every loss. It is about refusing unnecessary risks that could permanently damage your capital. Wealth grows more easily when it spends less time recovering from avoidable mistakes. The third decision is to stay within your circle of competence. Buffett has never believed that successful investors need to understand everything. Instead, they need the discipline to recognize what they truly understand and, just as importantly, what they do not. Ignoring opportunities outside your knowledge often creates better long-term results than chasing every exciting trend. The fourth decision is to give compounding enough time to perform its quiet work. Most people dramatically overestimate what can happen in a year and underestimate what consistent decisions can achieve over 20 or 30 years. Buffett's fortune is not simply a story of high returns, it is a story of extraordinary patience. The fifth decision is to treat patience as a competitive advantage. Financial markets reward activity with excitement, but they often reward patience with wealth. Buffett has frequently said that investing is one of the few fields where doing nothing can sometimes be the smartest decision. The sixth decision is to continuously invest in your own knowledge. Markets change, businesses evolve, and economies shift, but the ability to think clearly improves through lifelong learning. Buffett has often described reading as one of his greatest investments because better knowledge consistently leads to better judgment. The seventh and perhaps most important decision is to build systems that make good choices repeatable. Great financial outcomes rarely depend on occasional brilliance. They emerge from ordinary decisions made consistently over decades. Saving before spending, avoiding emotional reactions, remaining patient, and following rational principles become powerful because they are repeated year after year. Viewed individually, each of these decisions appears almost ordinary. Together, however, they form a framework that has remained effective through market crashes, economic booms, technological revolutions, and changing generations. While the world continues to evolve, disciplined decision-making remains one of the few financial advantages that never goes out of style. If Warren Buffett's principles are so simple, why do so few people consistently follow them? The answer has very little to do with intelligence and almost everything to do with human psychology. Financial markets are not only places where money changes hands, they are places where emotions are constantly tested. Every day, investors are asked to make decisions while surrounded by uncertainty, optimism, fear, and endless opinions. In that environment, even rational people can begin acting irrationally. One of the strongest psychological forces is fear of missing out. When a stock rises rapidly or a new investment trend captures public attention, it creates the feeling that everyone else is getting richer while you are standing still. This fear pushes people to abandon careful analysis and chase opportunities simply because others appear to be succeeding. Buffett has spent decades resisting this pressure, understanding that an investment only becomes attractive when it makes sense, not when it becomes popular. An equally powerful force is loss aversion. Behavioral research has shown that people experience the pain of losing money much more intensely than the satisfaction of gaining it. As a result, many investors panic during market declines, selling quality businesses at precisely the wrong moment. Buffett, however, has always viewed temporary market volatility differently. Instead of asking, "How much have I lost today?" he asks, "Has the long-term value of the business actually changed?" This simple shift in perspective transforms fear into rational evaluation. Another invisible obstacle is recency bias, our tendency to believe that whatever has happened recently will continue indefinitely. During bull markets, investors convince themselves that prices will keep rising forever. During bear markets, they become equally convinced that recovery is impossible. History repeatedly proves both assumptions wrong, yet emotions make them feel true in the moment. Social comparison quietly strengthens these biases. Modern technology allows people to constantly compare portfolios, lifestyles, and investment successes with others. Instead of measuring progress against their own long-term goals, they begin measuring themselves against strangers whose circumstances, risks, and objectives may be entirely different. Buffett has often emphasized that successful investing is not a competition with other people. It is a process of making consistently rational decisions over time. Perhaps the most important lesson is one Buffett has repeated throughout his career: temperament matters more than IQ. Extraordinary intelligence cannot compensate for emotional instability. A calm investor with average knowledge often achieves better long-term results than a brilliant investor who constantly reacts to headlines, market swings, or public opinion. Ultimately, the market is not designed to test how much you know. It tests whether you can remain disciplined when emotions encourage you to do the opposite. Those who learn to manage themselves gain an advantage that no economic cycle can easily take away. Because while markets will always fluctuate, human psychology has remained remarkably consistent across generations. After exploring Buffett's principles and the psychology behind them, one important question remains: how can an ordinary person actually apply this way of thinking? The answer is simpler than many expect. Buffett has never relied on complicated formulas or constant market predictions. Instead, he has developed a disciplined process for making decisions, one that filters out emotion before capital is ever put at risk. Imagine pausing before every significant financial decision and asking yourself a small set of timeless questions. The first question is, will this decision still make sense 10 years from now? Markets often tempt us to focus on tomorrow, next week, or next quarter. Buffett's perspective stretches much further. If an investment only looks attractive because of short-term excitement, it may not deserve your money. Thinking in decades rather than days immediately eliminates many poor decisions. The second question is, am I reacting to emotion or responding to evidence? Fear and excitement can feel incredibly convincing in the moment, but they rarely provide reliable guidance. Buffett has built his career by separating temporary emotions from lasting business value. Before making any decision, it is worth asking whether the facts have changed or only the headlines. The third question is, do I truly understand what I am investing in? One of Buffett's greatest strengths has never been knowing everything, it has been recognizing the limits of his own knowledge. Staying within your circle of competence is not a limitation, it is a form of protection. Opportunities will always exist, but confusion should never be mistaken for potential. The fourth question is, what could permanently go wrong? Most investors spend their time imagining profits. Buffett begins by imagining risks. By protecting against permanent losses first, he gives compounding the opportunity to work uninterrupted for years. The fifth question is, would doing nothing actually be the better decision? Modern investing encourages constant activity, yet Buffett has repeatedly shown that patience is often a competitive advantage. Sometimes the highest return decision is simply waiting until the right opportunity appears instead of forcing one into existence. Finally, ask yourself, does this decision strengthen or weaken my long-term compounding? Every financial choice either adds momentum to your future or quietly slows it down. Saving consistently, avoiding unnecessary debt, investing in productive assets, continuing to learn, and resisting emotional reactions may not feel dramatic today, but over decades they create outcomes that seem extraordinary in hindsight. Viewed together, these questions form more than an investing strategy, they become a lifelong decision-making framework. Markets will change, technology will evolve, and new opportunities will always emerge, but the ability to pause, think clearly, and act with discipline remains one of the most valuable financial skills a person can develop. In the end, better investing begins long before buying or selling. It begins with asking better questions. When people look at Warren Buffett's extraordinary success, it is easy to focus on the billions of dollars, the famous investments, or the companies that produced remarkable returns. Those achievements are certainly impressive, but they are not the most valuable part of his story. The real lesson is much quieter. Long before the wealth appeared, there was a way of thinking, a commitment to making thoughtful decisions, remaining patient when others rushed, and staying rational when emotions threatened to take control. That is perhaps the greatest misunderstanding about wealth. Many people believe financial success arrives through one life-changing opportunity, one brilliant investment, or one perfectly timed decision. Buffett's career tells a different story. His success was built one decision at a time. Each careful choice may have seemed ordinary in the moment, but over years and decades, those decisions compounded into extraordinary results. Wealth, in many ways, became the natural consequence of consistently choosing discipline over impulse. The same principle extends far beyond investing. Every day presents small financial decisions that appear insignificant on their own. Choosing to save instead of spend unnecessarily. Taking the time to understand an investment before committing money. Remaining calm during periods of uncertainty instead of reacting to fear. Continuing to learn rather than assuming you already know enough. None of these choices will make headlines tomorrow, yet together they quietly shape the financial life you will experience years from now. The future will almost certainly look different from today. New technologies will emerge, industries will transform, markets will rise and fall, and economic cycles will continue just as they always have. No one can predict every change with certainty, not even Warren Buffett. But what has remained remarkably consistent throughout history is the value of sound judgment. Rational thinking, patience, discipline, and respect for long-term compounding have survived every era because they are rooted in human behavior rather than market conditions. Perhaps that is why Buffett's lessons continue to resonate across generations. They are not dependent on a particular stock, country, or decade. They are principles that remain useful whether you began investing 50 years ago or are just beginning today. The tools may evolve, but the foundations of intelligent decision-making rarely change. As this video comes to an end, remember that becoming richer than most people is not necessarily about earning more, predicting more, or working harder than everyone else. More often, it is about making fewer avoidable mistakes and allowing good decisions enough time to compound. Every thoughtful financial choice you make today becomes part of a much larger story, one that your future self will eventually inherit. So the next time the market becomes noisy, headlines create uncertainty, or the crowd rushes in one direction, pause for a moment and ask yourself a simple question. Am I making the decision that serves my future, or the emotion I feel right now? The answer to that question may matter far more than any stock you ever choose.